liabilities or publicly traded IOUs. One of the major reasons why we do ratios here to find out how much debt a corporation has, also called fixed income securities, since payments are fixed amounts. The borrower agrees to repay a fixed amount of principal at a predetermined maturity date, and the borrower agrees to pay a fixed amount of interest over a specific time. That's why seniors or someone on a fixed income would look for bonds. They can usually get a higher yield than you could from an income type stock fund. Why would an investor want to invest in a bond? They can provide current income for many conservative investors. That is why investors receive these types of investments safer. Remember, the company should go bankrupt or out of business. The bondholders would be repaid before the stockholders. At times, they can provide capital gains or losses for more aggressive investors, which we will talk about the interest rate risk factor. Some bonds can provide tax-free income, such as municipal bonds. For example, if you buy an Ohio municipal bond, you would not have to pay taxes at the federal level or the state level. And lastly, they can be used for preservation and long-term accumulation of capital. As I stated throughout the class, interest rates and bonds are very important. Bonds currently are an attractive investment, seeing that they're paying a lot more than CDs. The behaviors of interest rate is the single most important force in the bond market. So if you buy a bond or a bond mutual fund, you want to look at interest rates. Interest rates in bonds prices move in opposite directions. Right now, interest rates are very low. If interest rates should go up, you would start losing money on your bonds. The value of those bonds would go down. So you may want to look for another type of investments to put your money into when interest rates rise. When interest rates rise, bonds will fall. When interest rates drop, bond prices will go up. So if you're interested in a bond and you thought that interest rates were going to go up in 2 years, but you did not like the current rate the CDs are paying, you could buy yourself a 2-year bond. It would mature in 2 years. You could get whatever the current interest rate was. In 2 years, the company would pay the principal, in which case you could reinvest into another investment as interest rates moved up. Bond markets are bullish when interest rates are low. Bond markets are bearish when interest rates are high or rising. Okay, figure 10.2 here compares the performance of stocks, which would be right here, and the value of 10,000 invested in bonds from 1997 to 2008. As you can see, bonds and stock rates have gone up and down. But currently here you can see bonds are currently paying more than stocks. So the average annual return of bonds from this time period is 6.18, which is a lot higher than what stocks have paid of 1.65. Okay, bonds and risk. Bonds are exposed to 5 major types of risk. Of course, we've already talked about the interest rate risk is the chance in a change in interest rates will have effect on the value of bonds. You have purchasing power risk is the chance that bonds yields will lag behind inflation. Of course, just like with stocks, you have your business and financial risk. It's the chance that the issuer of the bond will default on interest and all or principal payments. Liquidity is the risk that a bond will be difficult to sell at a reasonable price, because as those interest rates would go up, your bond price would go down. And of course, we're going to talk about the call risk, is the risk that the bond will be called. And we'll talk about that. That's when the company retires it before its scheduled maturity date. income a bond provides relevant to its current market price. For example, if an 8% bond is currently priced in the market at $875, then its current yield is, you take 1,000 times the 8% divided by the current value of the bond of $875, which we show right here. So we take the interest of 80, taking 1,000 times at 0.08 divided by the current price of the bond, and your current yield would be 9.14%. Okay, continue on with features of bonds. You have your principal or your par value, the amount of capital that must be repaid at maturity. Maturity date is the date when the bond matures, and the principal must be repaid. Term bond is the bond that has a single maturity date. Serial bond, the bond that has a series of different maturity dates. And notes is a debt security originally issued with a maturity date from 2 years to 10 years. Okay, let's look at the principles of bond price behavior. Prices of bonds is a function of its coupon rate, its maturity, and market movements in interest rates. Longer maturities move more with changes in interest rate. So the longer you have, a 30-year bond will move more with interest rates than a 1-year bond, because remember, a 1-year bond has a maturity date of 1 year. So it makes no difference what the interest rate is, because the company or whoever you buy it from, for instance, it could be a company or the government, still has to pay back the original principal. Okay, you have premium bonds as a market value that is above par. So let's say the bond is $1,000 and it's selling for $1,100. It's a premium bond, occurs when market interest rates are below bond coupon rates. And then, of course, you have the discount bond. That is what happens when interest rates go up, and the market value that is below par value occurs when market interest rates are above the bond coupon rates, and that's where the bond is going to lose value. You may have a capital loss if you should sell out or sell that bond before the maturity date. And figure 10.3 here shows the price behavior of bond here. As you can see here, price of a 10% bond when its current yield is 8%, so it's selling at premium. Same with 9, par would be at 10%. As interest rates start to go up, you can see you start going to discount there. There's 11, and then this is an example here. Your 10% bond now paying 12%, which has a, like I said, a decrease in the bond price. Okay, let's look at an issue that a bondholder would have a concern, and that would be the call feature, which allows the issuer to repurchase the bond before the maturity date. Bond may be freely callable. Issuer can prematurely retire the bond at any time, which would not be good for the bondholder. For example, if you were receiving a 10% interest rate on your bond and current interest rates are 8, if they call that 10% bond, once they paid you, you could not find a 10% bond because currently bonds are going for 8%. So that would be a feature that a bondholder would like to know. Of course, non-callable would be the type of bond they would like to receive. And then you have deferred call until after a certain length of time, then they could call the bond. Then you have the call premium, which is the amount added to the bond par value and paid upon call to compensate the bondholder. Usually 8 to 12 months interest rate at the earliest date of the call, and then becomes smaller as the issue nears maturity. Okay, call price is the bond par value plus the premium. Refunding provision prohibits the premature retirement of an issue of proceeds of a low coupon refunding bond. If it had that clean cash to retire the bond or cash on hand, can retire for any reason except to issue a lower rate bond. So you like a bond with this type of provision, that they can't just issue it just to lower the interest rate. signed by an organization to help repay a bond issue. The bonds are different types of classes of bonds. Some are more secure than others. Types of secure debt. Of course, the best would be secure debt is backed by pledged collateral, such as a machinery or building. That way, if the company defaults, you could claim ownership of that property. Senior bonds are backed by a legal claim to specific assets. Mortgage bonds are backed by real estate. Collateral trust bonds are backed by securities, stocks, and bonds held in trust by a third party. Equipment trust certificates are backed by specific pieces of equipment, such as rail cars or airplanes. So these would be secure type debt. Okay, let's look at types of unsecured debt. This is the unsecured debt is backed by only the promise of the company to pay. So you do not have assets to go against. So with this type of bond, you would expect to have a higher interest rate than the secured debt. Okay, junior bonds are backed by only the promise and good faith of the issuer to pay. That'd be just like you and a credit card compared to you and your house mortgage. Your house mortgage is secured by the house. Your credit card is secured by the promise of you to pay. Debtors is an unsecured junior bond. Subordinate debtors are unsecured bonds whose claim is secondary to other claims. Income bonds require interest to be paid only after a specific amount of income has been earned.